The big question with pension schemes at the moment is you can't just chuck out people when they retire. You need to provide advice. And it's like, no, they don't want advice. They want pensions. This is really simple.
This conversation has made me question my approach so far.
The schemes are basically chucking out people at retirement. Thank you very much. You no longer work for me. I'm not going to take any responsibility for you.
What if really serving investors meant going through the whole universe of investment instruments rather than shiny new object?
All we are doing is we are creating an investment pool with an income element and using the income element to match the expense needs of the individual.
So this has been a fascinating conversation with Doug Brodie. So you're the CEO of Chancery, a firm that's involved with retirement income planning. Maybe we can start with that because there's a lot of players in this wealth and financial advice fields.
Mm-hmm. I joined this industry in the late 1980s. Back in those days, the industry was run by the giant direct sales forces that were put together by the insurance companies, because back in those days, everything was commission driven, which is why you had the explosion of unit trust. So unit-linked assets came out of the insurance companies. They came out of Hambro Life and then Allied Dunbar and then exploded. That's where all the unit-linked came from. And it's important to remember that, why open-end funds came from. Then through the 90s, I specialized in investment. I was always quite nerdy with maths and trying to work out how one looked at projections for investments in over coming years. Because the great thing about all the charts is that tells you what happened last year, but last year's profits have already been earned, whereas an investor today is looking for this year's. I've always worked with the client side. I worked on one of the large South African insurers with clients that were big enough that they actually had their own individual funds that were listed in the FT. So it was a fascinating insight into how those were created and a big learning experience for me. And then I set up my first advisory firm in 1994. That was Master Advisor. Then all that's happened since then is in working face-to-face with clients. Come the middle of the 2000s, you get pension freedoms. Two things happened. Actually, three things happened. Pensions freedoms kicked in 2015, and George Osborne famously said, no one need buy an annuity anymore, which just made sense. Why was an annuity compulsory product at that stage? It was people's own money. The second thing that happened was QE destroyed yields. So everyone ended up with pots of cash, but no rational way of having material income. And then the third thing that really drives it is you've got all the baby boomers retiring. So personal pensions were started in 1987. You roll forward 30 years from that, and then all of a sudden you see, here's these things all coming together. So in having a chat with one of my clients at that stage, who was the main board marketing director of Marks and Spencer, a guy called Steve Sharp, and Steve pointed out that M&S's entire business model was marketing to baby boomers, marketing to people above the age of 50. They weren't in the teenage customer mold. And back then at M&S, he had a research team of over 30 people. You look back and thank God, the luxury of having that. So he and I sat down and decided that we should get some external investors and see if we could corner the market in the retiring baby boomers, because no one was doing that at that time. And the problem that we were dealing with was simply the problems that people had been walking into our office with for the previous 20 years, which is, I'm over the age of 50, I've got 100, 200, 1 million squid, and actually what I need is income. So as annuities disappeared and pension freedoms opened up the market, what was happening was people were walking around with 250, 350,000 and more in their pots, and they didn't want the 350. What they actually needed was 20,000 a year. So you spend all your working life basing your financials around an income paid at the end of every month, and then you normally voluntarily make yourself redundant and you've got no income, so you need to replace that income. You set that side by side with what's happening in the large market. You look at the schemes and what the schemes have been doing, and the schemes are basically chucking out people at retirement. Thank you very much. You no longer work for me. I'm not going to take any responsibility for you. And off you go. And here's your pension. We've done a good job for you. And you've got 300,000. And people are saying, I don't want 300,000. I want £20,000 a year. Now, the interesting thing there is you don't see members of final salary schemes walking around saying, oh, I don't know how much income I need. So their lifestyle is directly controlled by the amount of pension income that they've got. On the DC side, so on the money purchase side, it's a completely different conversation where people say, right, how much money do I need? And so a large amount of what we do is financial education and managing expectations for people. And so we got the external shareholders in, and the initial question that we had from those shareholders, most of the shareholders are industry grey hairs. And they said, right, go and put together £1 million and see if you can find the market and see if you can land the market. So we started on that, and it's quite interesting when we did the initial marketing, because part of the initial marketing spend was on digital assets, even though I kept my mouth very quiet. So I've been in the industry for quite a long time, and I know where these type of clients go for advice. So we burned a series of money on digital in a very short period of time.
Sorry, what year are we talking about now?
This is 2019.
All right.
It's not early times. Well,
familiar?
Don't worry, it's well after the interweb was created. So we burned an awful lot of money on digital and got a huge volume of absolute rubbish came straight through. So we just switched it all off and went back to what we know works in our market. So retirees, they actually like reading papers and they read the weekend press. So since then, that's all we've done. And to date, we've had $250 million requests for advice and guidance through that recycled advertising budget. So we stopped advertising because we couldn't cope with the amount of people coming through. And here we are.
Wow, that's quite a good, I need to pause on that because that's definitely something really interesting in terms of marketing and knowing your market.
Yeah, absolutely. So when you look, if you're a person above the age of 50, you can't go onto the internet without being hammered with how long's 250,000 going to last? What does £1 million buy? Get our guide here, get our guide there.
Yeah, I'm not there yet, but I get it as well, but I'm not far.
Yeah, so, and part of the difference is we are not an asset manager. Okay, so we have nothing with our name on it. We are very truly independent, and we treat each client individually. What happened next was really quite interesting because having worked in this area in central London for 20 years, when we were going to direct market for this market, we reckoned that the average amount of money that might come into us would be around 350, 360,000. But very shortly, we discovered something very different. The average was between 1.2 and 1.4 million. So we couldn't work out why is there such a large amount of money floating around, because irrespective of what you read, I can tell you 1.2 is a fully funded pension. Yes, there will be a tiny percent of people above that, but 1.2 is going to put you quite genuinely in the top 1 or 2% of pension holders in the UK. So we couldn't work out why these people were walking around with so much money. And then we discovered they're all coming from company pension schemes. So they reached the end of their tenure at 60 or 62. The average age has always been 62. And the companies are saying, there you go, you've got £1 million. You're no longer an employee. We have no responsibility or liability. Off you go. And so they're walking around with big pots of money, trying to find guidance on what do I do with my lifetime savings? There is no plan B. when you're 62, right first time.
And you talk about pot of money, and I know there's all sorts of different pots of monies and they have fiscal characteristics, etc. But is it their cumulative pot of money? Is it all a part of a pension wrapper? Is it how does it
it's
work?
basically pensions and ISAs that they've got.
Pensions and
So
ISAs.
it's tax wrapped money that people are using for retirement purposes. It's their retirement savings that they have.
Right. There's also potentially some interesting tactics, right? Considering the fiscal incentive, etc.
Yeah.
Without going too much into the details, but I realize, there's certain things you can do to make sure that you want to pay as little tax as possible. You want to maximize the benefit that you have been paying into your pension. How much of your advice is also tactical on trivial, right?
No, it's tactical. And so the first thing that happens when we speak to people is we put them through a financial planning process that is anchored around creating a lifetime cash flow. And it's anchored there so that we can agree with the client, this is what you want and this is what you need. So at the end of every 12-month period, Mr. Client, you can measure us against this cash flow. Here's what we were doing. So you can't simply say, it's been a lousy year because China's fallen out with Taiwan. Hey, look, here's your pot of money and guess what? It's down 10%. You can't pay your gas bill on that basis. So one of the things that we are doing, and I think it is absolutely fundamental for people to understand, is we're reclaiming a pension for what it is. A pension is an income. A pension is not a pension pot. A pension pot is a fund of money. But the pension that you and I and our parents and our grandparents grew up with and what we're going to get from the state, a pension is a monthly income. So all we're doing is we're rewinding it to that. When we go through the financial planning exercise, that slows everything down. So we've got enough time to run through the needs and objectives, which is the classic phrase, but actually it's a big education process. Our team here, almost everyone is above the age of 45, and they're that age for a very specific reason. It's because we have to manage people's expectations. We're not rocket scientists. It's actually very, very simple what we do, but what we have to do is we have to break down the embedded views that people already have when they come to us. So if you're talking about financial planning techniques, actually, if you maximize your pension from day one, you maximize your ISAs, both you and your partner from day one, you will probably have enough cash sitting in there. What's really important is you don't use your pension and your ISA as a trading account. That is destructive. There isn't a person who walks into our office who hasn't heard of Warren Buffett, but everybody, all the direct investment platform SIPs, they are all feeding on the basis that you mustn't pay attention to Mr. Buffett. You can do better. You have to transact. Look at this leveraged ETF, etc. That's just ludicrous for creating pension wealth. We include ISAs as well.
So there's something there about mental models and education, right? And we discussed with Smart Pension. One of the things we discussed was that people have lost our model. It used to be simple, defined benefits, work, and then get what you earned. But the model is a bit lost. From what I see is I think what you're saying is that we have given up a bit, or that there's not so much about this thing. It's all about wealth accumulation, and we don't think about, what do we do after? And that also kind of makes me think of the general education about financial education in general. As I just walked in front of the eToro bus, and they have an eToro Academy, and everything is geared towards, analyzing single stocks, trading more stocks, etc. So there's a lot of, so you talked about the education side of things. So there's all that, right? There's the ignoring this and reframing your mindset about the rest.
You just mentioned accumulation of wealth. But what investors in the UK, we talk about investors as someone who's funding their own pension. That is an investor. They have no concept of the correlation between capital and income. because we're not taught that. And the investor marketing departments of the funds and for the platforms, they die unless you're transacting. We come at it from a different way and say, look, stop, take your hands off, go away. It's the old Rip Van Winkle story where if you had to go to sleep for 20 years, what would you do with the money? Would you go and put it in CFDs and leveraged ETFs, or would you just buy a tracker and walk away? You'd buy the tracker. Everyone would, and anything else would be lunacy. So it's running through these models and demonstrating to people that £1 million is only going to last you for a certain period of time, whereas £1 million in income terms, if you're talking about 4 or 5% yields, so your £1 million is now back down to £45,000. And if it's through your pension, that's going to be taxable. So, your £1 million could give you a net income of £3,000 a month. How wealthy do you feel with your £1 million? You think, oh my goodness, it's $1 million and I'm not using it properly. So the education process takes them through, here's what the income will actually look like. And when you come to talk to us at 62, the 72-year-old version of you is going to be grateful that you follow a rational method of investing right now. That 72-year-old version of you is going to be well hacked off if you decide to chop and change in the markets and try to chase up the S&P 500 with their returns over the last couple of years.
Yeah, see, now that's really interesting in terms of going back to this model, because we said, okay, we lost our traditional model, let's say like a post-war model, and baby boomers have to adapt. And you mentioned this 40 years from 1987 to 2027, so we're right at the cusp of it. In fact, what it seems to be is we have to be flexible in our mental model, because once is accumulation, then you have to go back to your old model where what you want is income.
What happened during the accumulation process, you don't really have to be involved. And if you're in a company pension scheme, they'll say, we give you fund choices, but the default's sitting there and your employer is throwing all the cash into it. All that support disappears when you're no longer an employee. Master trust, they will try and keep the money sitting in their master trust, and they are just now starting to look at the tools and the help and support that's needed. But from the company scheme, you're still getting chucked out the door. So what happens is we're getting asked a lot now about advice for people coming out of the schemes. And the main issues are the low-sized pots that people have got. So there's a master trust that we've been in conversation with who have 30,000 retirees every year. There's another one that's got 60,000 and 70,000 transferees going out. Now, these are all small pots of money. So if we take Mrs. McGregor retiring from Cabbage Patch Engineering Limited, and she's got £50,000, she doesn't want advice. She wants a pension. So if you've got someone retiring with a small pot, it's most likely that they are not going to have high financial literacy. So why would we start saying, let's do a risk assessment for you? She doesn't want a risk assessment. She just wants a pension. This isn't rocket science, and this has nothing to do with investment engineering. This is all to do with basic understanding of behavioral economics. That's all it is. And so what we bring specifically through Chancery Lane is we're experts in the behavioral economics side. We know what people want. So when we do, and the reason Steve Sharp got excited about that when we started running his money is every time he'd come to see us once a year, we'd put up the table that said, here is how much money your investments have earned cash into your SIP and ISA bank account over the last 12 months. And above that, here was the previous 12 months, and then the previous 12 months, and then the previous 12 months. So he could see it goes click, 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 click. It's so utterly predictable. And it says, here is exactly how much cash income that's been generated by your assets. And the question is, isn't that what a pension is supposed to be?
Yeah, that's really interesting. Let's
You mentioned defined benefit, and you mentioned talking about the model. We call this projected benefits because we can run the projections. Now, we do have a luxury in that because we are a broker, we're not a product manufacturer, we are not hamstrung by the FCA saying, hey, look, you need to project everything at these identical rates. So we do a lot of research into what the growth rates are and the income from the assets we use. And from that, we will run a projection for a client that runs over the next 10 or 20 years. We can show them with accuracy what their income is going to be. And then at the end of every 12 months, when we do the update, bear in mind, we've already said our projection was, for example, £42,500. That's naked investing, because when the client comes in, we've given a target on our back. We've said £42,500, and with the accuracy that we've got, we are always within 1 or 2% of that figure. Actually, I'll tell you a secret: we always lowball the income projections, because that way clients are always kept happy. And the whole point about what you do when you're investing for income for clients is to remove anxiety, so that when the clients are out traveling in Bhutan or going to visit their grandchildren in Australia and across the news it says markets crashed, they know that's not me, not involved, that's not going to touch my income. Isn't that what everybody wants? Isn't that exactly what the value is on a final salary scheme?
I've got two reflections on that. Trying potentially to see the limits of this model. One, the thing that I've experienced myself with family members that are just looking at incomes and therefore let's just say you've got typically what they had is a bond fund or whatever. And they pay income and they offer this income value, and people are very happy with them. But on the other hand, the value of the fund has dropped dramatically. And I mean, you might tell me you don't have to consider it, but I think you somehow also have to consider a little bit, because if it pays, basically, otherwise it's a Ponzi scheme, right? Also, if it pays the income that's not generated. And so you may think of that. And the second thing that I thought of is the success of the most successful fund of our times, which is BREIT. I'm not sure if you're familiar with it, but it's the 70 billion, the Blackstone Real Estate Income Trust.
You said income there, didn't you? Funny that.
No, exactly. It sounds like REIT, which is
investment trust. So, funny that.
Okay. It's a discovery process, but BREIT, I think, is delivering a fantastic experience to the client because it's income and never falling down, right? People have criticized it heavily. Some people say that the market should have been 20% lower and the NAV didn't reflect that. There are some issues at some point, because if the NAV is higher than you think, you might as well unwind it because it's a good opportunity. They manage that. But to me, that's the risk of this focus on income without looking at the value. So I don't know how you approach it.
One of the questions that we get all the time is, why doesn't everyone do this? And the answer is, in the major pension schemes, they do. This is exactly what they do. So all we are doing is we are creating an investment pool with an income element and using the income element to match the expense needs of the individual. So if you need £3,000 a month, you have to have that £3,000 in income, but you use the multi-asset investment portfolio to keep that cash topped up. And the example that I use is the Rolls-Royce Pension Fund. Rolls-Royce Pension Fund has got payments out, looking at 2023, 290 million. It's income, investment income, not capital. It's investment income and not employer money. Its investment income is 240 million and the 290 million that was paying out. Cash at the bank. So imagine your own SIP. You've got a bank account sitting in your SIP. Their cash at the bank is, or end of December, was £1 billion, just over £1 billion, £1,070,000. So that's £1 billion in cash to support expenses being paid out to members of 290 million. We do exactly the same, but on a micro basis. So what we do is like a personalized final salary scheme, which is why we call it defined benefit. The other luxury, which we can't replicate, the luxury that Rolls-Royce pension scheme has got, is they have an employer to underwrite it. Now, the question there is, if you remove that underwriting, does that mean the income's not going to come? And what you have to look at for that is, we're talking about property REITs, looking at the income from there. The reason that you don't do fixed interest, and between 2007 and 2012, almost all our money was in fixed interest. With the income yields that we had with that were just glorious. And every now and then in a pub, you say to your mates, "God, please can I have just one more credit crash before I leave the industry?" Because it's all maths. So it's all very straightforward mathematical models to work out what the returns were going to be. As QE kicked in, then we lost. What happened is the capital values came up. So you lost the ability to put new money into that market. So we went looking around, where do we get this? And eventually ended up in the investment trust sector. Now, the interesting thing about the investment trust sector, if you just treat it as multi-asset investment, all of a sudden you get to be able to deal with the biggest problem that you'll hear from all the professionals working in the industry, and you'll hear it from politicians as well. Yes, but what about inflation? Inflation is solved if you look at it on a 5-year rolling basis. If you try to solve each individual year, you will get caught with the outliers like we had in 2022 when it spiked to 11%. But I can tell you that with our core research data that went back to 1986, running the investment trust dividend increases back to back with RPI, not CPI, it's 130% of inflation. It just completely destroys it. And you can look at that and say, yeah, one of the criticisms that sometimes get thrown at us is we need to run our data across a 100-year period for it to be statistically relevant. Well, I can show you absolutely staggering charts comparing the dividends from F&C Investment Trust against inflation. And bear in mind, F&C started in 1868, which is 9 years before General Custer fell out with Crazy Horse at the Battle of Little Bighorn. So they're still playing cowboys and Indians over there, and we were inventing investment trust. And F&C, so it's not guaranteed, and there is no employer underwriting it, but it's never failed to pay an income. So when you look at it and say, well, surely a pension needs to be guaranteed. The trouble is, if you do that, you've got to do an annuity, you've got to go gilts, and you've just destroyed your yield.
I've got a lot of questions about investment trust, but before we go into that, I just want to finish and sum up what you've said, because it really answered my question. First, the income is real income. It's not people paying out of capital, which some funds can do. And secondly, it's not dogmatic. It's an opportunity because of how the yields have evolved and so on and so forth. But so we're going to go to investment trust. I think it's a topical, a very important topic and a useful tool. But I also want to go back to this earlier take that you have, because you have a spicy take on the industry, which we have fully addressed, although I understand what you're doing differently, is that perhaps this whole industry that looks after pension is not fully doing their job somewhere?
They're doing their job. So this was brought home to me in 2008, beginning of October 2008, and we were doing TV interviews with the BBC as the markets were collapsing. And I was in a lift in the BBC with a UK equity pension fund manager from one of the big household names that you and I know. And I asked him what he was doing with his money. And he said, 95% of my fund is invested in the markets and is falling off a cliff. 100% of my own SIP is sitting in cash. And that really crystallized for me. They have a different job.
And I asked a bad question. I shouldn't have said that. They do a different job.
Yeah.
Okay,
no, they do their job, but it's a completely different job. It's a telescope. So they're looking through the small end, we look at it from the big end, because we start with, what does the person actually want? So now the big question with pension schemes at the moment, and we've got it, from the King's speech last year, is you can't just chuck out people when they retire. You need to provide advice. And it's like, no, they don't want advice. They want pensions. This is really simple. So what we do is we're building the tools, digital tools, that can cope with 30,000, 50,000 people a year. And the way to do that is you keep it dead simple. And we could discuss how you build the algorithms, where you use AI to put everything together. That's really straightforward. But for your industry people looking at this, all they need to do is go and look at PensionBee. Romy Savova has done a fantastic job in simplifying what the process is. She's now got over 250,000 members of her pension schemes. That's demonstrating how simple the digital is. And if you give the people what it is they want, which is, I just want a pension, then they'll tick the box and off they go. But you wanted to talk about investment trust, and I guess if you look at what Saba has been doing over the recent times, they've all come into the news. The first thing we would clarify with investors, we're using them because it's a really simple way for a small firm to outsource that income generation, so that they are fully wrapped vehicles. They're multi-asset and they've got reserves.
Just for everyone else, like, what is different between an investment trust and a fund?
A unit trust is a fund, is a pot of money that is manufactured and administered and sold by an investment manager. So if you want to invest in a Fidelity unit trust, effectively you go to Fidelity. So the buy order goes into Fidelity and they offer you the units. When you sell back, it's actually Fidelity who send the check back out to you. With an investment trust is a company. It's Murray International Limited. It's F&C Limited, Murray Income Limited, JP Morgan, Claverhouse Limited, and they're all listed on the stock exchange. There are a few specialist ones listed in the Channel Islands, but for most people, they are companies that are listed on the London stock market. The big arguments that go through are to do with the difference between the NAV and the actual market cap. So it's the NAV per share and the actual share price. There's another issue on costs that I'll come to.
And is that because what type of assets do you invest in? They invest in public stocks and also private?
So an investment trust that invests just in property is called a REIT. So you have things like Supermarket Income REIT, and all they do is they buy and lease back supermarket properties to Tesco, Sainsbury's and people like that. Then the main ones are multi-assets or very investment focused. So you'll have international equities or you'll have emerging. So Schroeder Oriental, you can tell it in the name. Murray International, you can tell it in the name. And then you have ones like Scottish Mortgage who specialise in unlisted stocks and looking for stuff that's going to go through the roof. And I was reading a note from Bailey Gifford on that. NVIDIA is one of the big stocks. Everyone's talking about, look how much they've gone up. They bought in 2016 with 65 million quid. Big call. The reason you get a disparity between the share price and the NAV is the NAV is the current market price of the assets that they hold. But the share price depends on the buyers and sellers. It's you and I buying and selling the shares of Murray International and the London Stock Exchange. And the two of them can split if you don't have, because the price is driven by the number of people coming in to buy. However, so technically you could have an investment trust that only owns Shell stock. So you've got the share price of the vehicle and you've got the share price of Shell, and there can be a disparity between the two. What Saba was doing is saying, look at this inbuilt gap and it's far too big. If we take over all the stuff, we can sell the underlying assets. So we can sell the NAV, we can realize the value, and we compress that gap. We make an instant 10, 15, 20% in it. Our approach back to Saba was, Because when they first got rebuffed, they then turned around and said, well, one of the strategies is we'll just take over these trusts and unwind them into open-ended vehicles. And our response to that was, you want an open-ended vehicle, then get your own microphone out and go sing your own song. Go and raise your own money. Stop trying to pinch everybody else, because actually it's not about running an open-ended fund. You just want to do a bit of sharp financial engineering. And fortunately, I don't think they'll succeed anywhere. I think this is another classic case, and people in the investment sector in the UK, we see this quite a lot. The Americans misread the UK market. Schwab's came over here in 2000 and 2001. And I remember meeting the people back then. Nothing happened. 2 years later, they went. Vanguard tried to do advice on their SIPs. 2 years later, they disappeared. Why? Vanguard, the company the size of it is, the reason was they wanted immediate profits to come back. It doesn't happen like that in the UK. We don't do the transactional business that they do in the US. Anyway.
So yes, it doesn't look like somebody's going anywhere. I notice myself as I follow this, there's some investment trusts, some spectacular discounts, etc. Overall, I feel like it's perhaps a segment of the industry that is not loved. And I have to contrast it with what's happening in the private market, where people seem to not be able to get enough of it, whereas they could be, somehow similar.
There's a very fundamental difference where I think the penny will drop for most people. If you want to invest £50,000 in Fidelity situations, you give Fidelity 50,000. Their funds under management go up by 50,000. If you want to invest £50,000 in Scottish Mortgage, you don't give the 50,000 to the investment manager for Scottish Mortgage is Baillie Gifford. You don't give 50,000 to Baillie Gifford to buy those shares off someone else in the market. So Baillie Gifford's money under management for Scottish Mortgage never changes. You go and put £1 million into Scottish Mortgage, they don't make any money out of it, which is why when you go onto the interweb, you don't have marketing departments for investment trusts. You have marketing departments for open-ended funds, because that's how they get more assets under management. It's simple. It's the business model.
So that's as well where the opportunity lies, because you prefer to have a fund that spends less in marketing, potentially, or somewhere else. So I have this aha moment.
Yeah. So the average MC that we'll see on an investment trust will be between 60 and 65 bits, something like that. Some of them, you go down to 30, which is just value for money. Because what we do is we measure it so we're income specialists, so we're only really interested in the income-focused trust, which means they tend to be older, they tend to be bigger, and we measure it by the income that they throw out. We don't measure it by the cost. Cost is a consideration, but it's not all. And you know that cost is only one consideration, because, now I can't see what's on your desk, but if cost was all, Apple wouldn't exist as a tech company, never mind being the largest company on the planet. Because why would you pay £1,000 for a phone if cost was all? You wouldn't. You'd pay £75 for a Chinese-made one.
Yeah. But if I was trying to probe a bit more this sum you mentioned, I don't know, how old are they, 150 years old or something like that?
Yeah, 156.
But that does feel unmarked. I guess one of my worries might be, are they keeping up with the times? Are they cutting edges? Are they making the most of, for example, technology?
It's an interesting question, and the answer to that is they've just raised their dividend by 6.9%, and I think their total return last year was just a smidge over 14%. Very effectively run by a chap called Paul Niven. But where it goes back to, so you're asking, is it efficient? Efficient for who? Because you as an investor, George, are very different to my mum. You're different from the person out on the street. The luxury that we have in Chancery Lane is we are only interested in income-based assets. That means the question you're asking is, is it efficient for capital distribution, taking into account new technologies? I don't really care. There might be, but that's not what we're investing.
No, I mean, my question is efficiency in terms of eventually, let's just measure it by the income distributed. What I'm trying to figure out is, as they work in a different way, what is the incentive, constant effort that these people are doing? If it's obviously finding the best income producing assets, yeah, how does it work? What drives them towards, doing the same or better?
You're walking into an area where we've been quite outspoken on this. Because it's a company, and the front of its annual reports, they're required to state this is the objective of the company. Now you get some investment trusts that'll say we're looking at, investing in bottom up or top down and making money over the long term. That's no objective at all. I mean, that's just an absolute cop-out. So when you go and look at F&C, it's looking at growing its dividend, growing the income stream through its dividend stream that is related to inflation or higher with underlying capital growth in its shares. You go back and track its record, it's knocking it out of the ballpark. It's that successful. The reason it's that successful, by the way, is one of the reasons is it holds about 12% of its assets in private equity. So it does a little bit of what Scottish Mortgage does. But it's a classic widows and orphans one. These investment trusts were first created as the first pensions. That's why they were set up, so that people could disappear to India or the Caribbean in the late 1800s and know that their money was set up and taken care of if they didn't come back, either for them when they retire or for their families. That's why these mutual funds were first set up. And they're still going strong. So do they work? Yeah, they do work.
That's a lot to reflect on. It's also a good reminder that we're always looking at new types of marketing, but you showed that sometimes older solutions work better. New way of thinking about pensions, investing, and so on. But the whole industry is pushing us towards that, but there's definitely a lot of value in thinking about what exists and what has proven its effectiveness, etc.
It's within the ecosphere of the investment market. Actually, there's lots of constituent parts, and those constituent parts do different things. So a lot of the master trusts do a fantastic job. They take the money in, but what they don't do is tell people this is what you're going to get. So if you look at how we see the industry in 5 years, in 10 years' time, it'll be a lot more focused back on this is what your pension is, and your pension is going to be measured in income. It's not going to be a pension pot. People are going to demand that. Once the master trust and the other company schemes get to see actually how straightforward it is, and they will need regulatory support in doing that. So the FCA needs to back off saying you can only project to X, Y, and Z%. Hey, look, leave the liability onto the scheme. Then people will have more clarity. So if you're a 38-year-old, you want to know, if I put £100 in my pension, what income am I going to get at 65? Currently, all you get is a sheet of paper that says, hey, thanks for putting the 100 quid in. This is your policy number and this is your retirement date. It tells you nothing credible about the income that you're going to get. I know from listening to one of your other earlier podcasts from a specialist working in the area of the bulk schemes, in his business, tax effectiveness for one of the ways they operate can manufacture a saving of 0.5% per annum. Now, from a retail perspective, they don't care about 0.5% per annum because you're investing in a market that last year, the FTSE in 2024 had volatility of over 1.5% per week. So 0.5% per annum to the individual is nothing. 0.5% per annum to someone running a corporate pension scheme of 2, 3, 4 billion, all of a sudden that makes sense. And especially so if you're running a DB scheme.
No, absolutely. We have to bring it back to the individual level. because when you're in the industry, you kind of think of the big picture. We could talk about our nautical
Indeed.
activities, which I think are a great way to spend
Retirement.
early and
Retirement is
exactly.
So retirement is all about retiring. It's not about pensions. Pensions, that's just the fuel.
Well, that's a great conclusion. All right, Duke.
Good.
Thank you so much.
It's been wonderful to talk to you, George.